Hello everyone, this is Jinesh Jain and you're watching Road to Intelligent Investing, where we talk about all the interesting stuff in the financial world, especially the stock markets. So in today's video, we are going to be doing the fundamental analysis of another company called Clean Science and Technology, which has recently come up with an IPO. I won't be doing the industry analysis as I've already done so in the fundamental analysis of alkylamines video. So check that out if you haven't already. Just to reiterate, the specialty chemicals market is set to grow at 5 to 6% at CAGR globally. Okay, so first let's talk about the company and its products. So Clean Science and Technology was incorporated in 2003 as a family-owned enterprise. They are into manufacturing fine and specialty chemicals using cost-effective methods. Clean Science and Technology has two production facilities at Kurkum, Maharashtra, with a combined production capacity of about 30,000 metric tons per annum, strategically located near the JNTP port. They manufacture functionally critical specialty chemicals such as performance chemicals, that is MEHQ, BHA and AP, pharmaceutical intermediates, that is guaiacol and DCC, and FMCG chemicals like Formap and Anisole. They have grown to be the largest manufacturer of MEHQ, BHA, Anisole and Formap in terms of installed capacity, in terms of installed manufacturing capacities as of March 31st, 2021. They have also increased their capacity utilization in a phased manner to ensure the production is optimally commensurate with the growing demand. Their customers include manufacturers and distributors in India as well as other regulated international markets, including China, Europe, the USA, Taiwan, Korea, and Japan. In fiscal 2021, 67.86% of their total revenue from operations came from exports, China being the major one at about 37%. In my opinion, a specialty chemicals company exporting to the biggest specialty chemical producer in the world, that is China, is nothing short of an exception. The following table shows you the key products and its application and the industry they serve. You may wish to pause the video and read in detail. Clean Science and Technology is a global leader in some of the chemicals it manufactures, like MEHQ, BHA, Anisole, Formap, and amongst the top in others like guaiacol, DCC, and L-ascorbyl palamate. Their products are used as key starting level materials, as inhibitors or as additives by customers for products sold in regulated markets. Key customers include Bayer AG, SRF Limited, Genex Laboratories Limited, Vinity Organics Limited, etc. Some of their customers have also been associated with them for over 10 years now, as of May 31st, 2021. If we look at their revenue mix, we see that almost 70% of their revenue comes from performance or specialty chemicals. For performance chemicals are the chemicals which make a product perform. For example, a chemical used to make clothes water repellent is a performance chemical. We should also understand what are the strong moats and entry barriers for a company before investing in it. So unlike IT and digital companies, specialty chemicals companies have an inherent entry barrier, as the industry itself is highly regulated. To be talking about specifically about the Clean Science and Technology, their major moat is that they are the lowest cost producers in some of the chemicals they produce. For example, they are the only company to globally deploy vapor phase technology for manufacturing anisole from phenol with better atom economy and only water as an effluent when compared to the traditional liquid phase manufacturing process. Consequently, they sell this anisole to other companies in India and abroad. This is probably one of the most interesting things to know about this company. With phenol being widely available and anisole being produced for capacitive consumption, they are integrated to the commodity level, which also helps them to reduce the cost and increase their profit margins. This has led to their distinguished position as the most cost competitive producer of these critical products, demonstrated by their significant exports to China and their highest margins in the industry in India. Time for some quick number crunching. Let's quickly look at the financials of the past 3 years. Total revenue from operations have grown at a CAGR of 14.15% between fiscal 2019 to fiscal 2021. In fiscals 2019, 2020 and 2021, PAT margins was 24.8% to 33.3% and grown to 38.71% respectively. EBITDA margin grew from 37.5% to 46.7% to 55.5%. ROC, the return on capital employed, grew from 50% to 58 to 73% in FY21, and ROE grew from 35.9% to 48.8 to 36.7% respectively. Now, optically ROE might look low, but this is because they have around 250 crores of cash on their books. Hence, excluding that, the real ROC comes at about 74%. Cash flow from operating activities was at 847 million rupees, which grew to 1600 million rupees and to 1928 million rupees in fiscal 2021. This just goes to show the extreme strength in the balance sheet of Clean Science and Technology company. To do some kind of a qualitative analysis, we might look at the parameter that is corporate governance. The promoters Ashok Ramanarayan, Siddhartha Ashok Sikchi, and Krishna Kumar Ramanarayan, and Parth Ashok Maheshwari. All these people are career technocrats with combined experience of over 60 years in the chemicals industry. The board is very strong with 1/3 of their directors as independent directors, and there are former directors from Sudarshan Chemicals and Aarti Industries too. Now let's address some of the risks before anyone looks at this company for an investment. So in fiscals 2019, 2020 and 2021, revenue generated from the top 10 customers represented 50%, 44.7% and 47.9% of the revenue from operations. This clearly shows their revenue concentration among their top clients. Hence, they run a risk of revenues getting impacted significantly when even one of their top clients decide to pull back from a deal, like we have seen in the case of Happiest Minds too. In my opinion, what I feel is that if such companies, such small and mid-cap companies, want to become huge and have economies of scale while diluting their risk, they need to diversify and expand their customer base, even at an expense of diluting their margins a bit. Instead of trying to venture into new product segments, if they are global market leaders in some of the segments that they already produce. Alright, let's now discuss some of the future prospects of this company. So Clean Science and Technology wants to continue to explore high margin downstream product lines which have low competition and multiple applications. They are in the process of developing a portfolio of stabilizer products to be used as additives or stabilizers by manufacturers. Similarly, they are engaged in developing catalytic systems to make intermediaries for application in high growth industries including paints and coatings, adhesives and sealants, and these are expected to be driven by the growth in the infrastructure segment. To expand capacities of existing products and venture into the producing the stabilizer products, they have recently set up a third manufacturing facility that is being constructed adjacent to their existing facilities in Kurkum, and have recently also been allotted a land for a construction of fourth facility in Kurkum, Maharashtra. To conclude the analysis, I can only say that this is a great company to invest in, looking at what their future prospects are, their current status quo, and their high competitiveness and deep moats. Don't forget to subscribe for more such videos. Until next time.